Medical debt on your credit report now depends on which state you live in, not just what you owe. For decades, credit reporting worked the same way everywhere in the country, regardless of what state you lived in. Medical debt broke that pattern first. Here's what that actually means for you. In plain terms, two people with the identical unpaid medical bill living in two different states can now end up with completely different credit reports. To understand why this happened, you need to understand how credit reporting law has traditionally worked. The Fair Credit Reporting Act is the federal law that sets baseline rules for what bureaus can report and how. For most types of debt, states can't pass laws that are less protective than the federal floor, but they can pass laws that are more protective. That's exactly what's happening with medical debt right now. 15 states, including Delaware, Maine, Maryland, and Oregon, have passed their own laws specifically limiting how medical debt can appear on a credit report. Put simply, these states decided the federal baseline wasn't strict enough for medical debt specifically and passed additional protections that only apply if you live there. Here's where it gets more specific to how this actually works at the reporting level. A furnisher is simply the technical term for whoever reports your account information to the credit bureaus. In this case, a hospital, medical billing company, or debt collector. When a furnisher reports medical debt, the receiving bureau now has to check something it never used to have to check: what state the consumer lives in, and whether that state has its own medical debt reporting restrictions. Most people hear this term and move past it. Don't. That state check didn't exist for medical debt reporting 5 years ago. It's a completely new layer in the reporting pipeline. This connects to something bigger happening at the same time, separate from state law entirely. The 3 nationwide credit bureaus made their own policy decision, independent of any state requirement, to stop reporting paid medical collections altogether, and to stop reporting medical debts under $500 regardless of payment status. Strip away the banking language, and here is what is actually happening. You now have 2 separate systems layered on top of each other: a nationwide bureau policy that applies to everyone, and a patchwork of state laws that only apply if you happen to live in one of the states that passed them. Here's why that layering matters in practice. If you live in a state without a specific medical debt law, your medical debt is governed only by the nationwide bureau policy. No collections reporting once paid, no reporting under the $500 threshold, but full reporting above that threshold if unpaid. If you live in one of the 15 states with additional protections, you get the nationwide bureau policy, plus whatever additional restriction your specific state passed on top of it. Those additional state restrictions aren't uniform either. Some states limit the dollar threshold further. Some states require debt collectors to wait longer before reporting medical debt at all. Some states ban medical debt reporting from appearing on a credit report entirely, regardless of amount. Now, here's something worth sitting with for a moment, because it reframes how you should think about this entire situation. Most people assume credit reporting rules are the same everywhere, because for most debt categories, that's historically been true. Medical debt has quietly become the exception, and almost nobody outside the industry has noticed the shift happening. That matters if you've ever moved states, or if you're comparing your credit file to a friend or family member who lives somewhere else and assuming the same rules apply to both of you. There's a regulatory layer here too, and it's still actively moving. Updates to the Fair Credit Reporting Act itself are also in progress at the federal level, aimed at speeding up dispute timelines and requiring better documentation for reporting errors, specifically tied to how the initial wave of medical debt protections rolled out. Here's the part they aren't telling you in most coverage of this. Because state laws and nationwide bureau policy both keep evolving independently of each other. The specific rules governing your medical debt today could look different in 6 months, even if you haven't moved and even if the debt itself hasn't changed. Put simply, this isn't a one-time update you can learn once and be done with. It's an active, moving patchwork. So here's the full mechanic, start to finish. For most types of debt, federal law sets one baseline that applies everywhere. Medical debt broke that pattern. Nationwide bureau policy independently stopped reporting paid medical collections and debts under $500, regardless of where you live. Separately, 15 states passed their own laws adding further restrictions on top of that nationwide policy, and those state laws aren't uniform with each other either. Whether your medical debt shows up on your credit report and under what conditions now depends on a combination of nationwide bureau policy and whatever specific law your state has or hasn't passed. In plain terms, the same unpaid medical bill can show up completely differently on two credit reports, purely based on which state each person happens to live in, not on anything either of them did differently. This is one of the clearest examples on this channel of how credit reporting has quietly stopped being one uniform national system and started becoming something closer to 50 different systems layered on top of a shared federal floor.